Welcome to PIMCO Pod. In this episode, we discuss two seemingly opposite behavioral biases and what they mean for investors. Stay tuned after the conclusion of the podcast for additional important information. Behavioral Insights for Investors: Reconciling the Hot Hand and Gambler's Fallacies by Anastasia Buyelskaya and Helen Guo. Cognitive bias is a major focus of behavioral research. Different compilations of cognitive biases vary in scope and taxonomy, but share one feature: they are very long. Many catalogs list well over 100 biases, and sometimes more than 200. Part of this proliferation is definitional. Behavioral scientists often subdivide closely related concepts. For example, overconfidence is commonly broken down into overplacement, overestimation, and overprecision. The result is an ever-expanding vocabulary of seemingly distinct behavioral tendencies. It is therefore unsurprising that some of these many biases appear to contradict one another. Two such biases, appearing to describe opposite behaviors, are the hot hand fallacy and the gambler's fallacy, and they are especially relevant for investing. Competing biases. The hot hand fallacy is the tendency to believe a successful streak will continue, even when the individual events are independent. The term comes from basketball, capturing the belief that a player is more likely to score after she has made several successful shots. In markets, the hot hand concept maps naturally onto a momentum strategy, an approach that relies on an expectation that assets that have performed well will tend to keep performing well. Trading strategies based on this momentum pattern have historically tended to deliver positive Sharpe ratios, a measure of risk-adjusted return, across asset classes. Notably, they often exhibit negative equity beta, suggesting their valuation trends tend to be distinct from the overall market trend. Since 1990, momentum approaches have produced positive risk-adjusted returns for major asset classes with limited correlation to broad equity markets. In other words, believing in the hot hand can potentially be profitable. At first glance, the hot hand belief that trends persist appears to conflict with gambler's fallacy, the belief that outcomes of independent events are systematically connected but in a different way, such that a fair coin that has landed on heads 3 times is due for tails. Translated into markets, this becomes the expectation that prices rising for several consecutive periods are bound to reverse. And much like the hot hand fallacy corresponds to the momentum approach in investing, the gambler's fallacy corresponds to a different well-documented market phenomenon: mean reversion, or broadly speaking, the expectation that what goes up will eventually come down, and vice versa. Explaining the coexistence of hot hand and gambler's fallacies. How can these two seemingly opposite-looking behaviors and belief systems coexist? Researchers Matthew Rabin and Dmitry Villanos address this question by proposing a theoretical model that reconciles the two. They showed that individuals who believe in the gambler's fallacy tend to overestimate the magnitude of changes in an underlying state while underestimating their persistence. Put differently, short streaks trigger expectations of reversal, but as a streak lengthens, individuals increasingly infer that a genuine regime shift has occurred. This in turn tends to drive a cognitive shift toward continuation rather than mean reversion, consistent with the hot hand fallacy. In this way, both investor behaviors emerge from the same mistaken intuition about how randomness works. Psychological explanations are not the only way to explain coexistence, of course. Structural features of markets can also produce both momentum and reversal without requiring cognitive error. Investors operate over different time horizons and face distinct liquidity and mandate constraints. For example, short-horizon quantitative investors in liquid markets often pursue momentum strategies because price continuation at intermediate horizons historically has been empirically persistent, scalable, and allows rapid exit if conditions shift. By contrast, longer horizon institutions, particularly those anchored to valuation frameworks or strategic asset allocations, may gradually reduce exposure as valuations stretch, anticipating eventual mean reversion. Heterogeneity in horizons, constraints, and objectives can therefore sustain both continuation and reversal forces within the same market. Biases across asset classes. What about differences across asset classes? Do equity or bond investors tend to be more prone to these dynamics and potential biases? While systematic comparative research is limited, the structural characteristics of each market suggest some possible distinctions. Equity markets are typically more volatile, both because of the underlying cash flow uncertainty and the greater presence of retail investors. Stock prices are also readily embedded in narratives. A company beating earnings may quickly be reframed as evidence of superior management or durable competitive advantage. As Robert Shiller has argued, narratives both drive and respond to market fluctuations. Moreover, equities, open-ended payoff structure, and generally weaker short-term anchoring to observable fundamentals can make continuation, hot-hand stories particularly compelling, especially in the short term. Empirically, momentum has been a robust feature of equity returns across markets and time periods. We see a general tendency towards short-term momentum in equities for the first 12 months of a trend, and then reversals tend to become more prevalent over a 2 to 5 year horizon. This pattern is consistent with the coexistence of short-term continuation and longer-term mean reversion. Bond markets differ in several respects. They are generally less volatile and have a higher proportion of institutional and other long-term investors. While macroeconomics is also susceptible to narratives, Shiller's work emphasizes themes such as secular stagnation, a theme PIMCO also has discussed. These narratives are often anchored in slower-moving macroeconomic variables. Inflation, for example, exhibits structural persistence and high serial correlation, whereas individual equity returns largely reflect rapidly incorporated information and idiosyncratic shocks. As a result, bond investors may be more prone to gradual updating errors or regime misclassification than to pure gamblers' fallacy dynamics. The market cycle and current biases. Given all of this, where are we in the cycle of investor behavior? Throughout 2025, commentators repeatedly warned that a bubble could be about to burst, a reaction consistent with gamblers' fallacy thinking after an extended bull market. So far in 2026, most commentators have downplayed such warnings, indicating that beliefs in general may have moved toward a regime change interpretation, and that a new state justifies continued hot-hand gains. U.S. equity market S&P 500 outperformance started in 2023, some 3 years ago. If we take the historical data as any indicator of what to expect going forward, a reversal could be around the corner. The coming year will therefore be a key test of whether we see mean reversion as history's patterns suggest, or whether progress in AI has indeed put us on a new trajectory in which momentum will continue. PIMCO has counseled investors to expect the unexpected this year. See PIMCO Perspectives, February 2026. Increasing one's awareness of unconscious cognitive biases of all kinds can help investors mitigate suboptimal decisions in such an environment. Thank you for listening. That was Behavioral Insights for Investors, Reconciling the Hot Hand and Gambler's Fallacies. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.